Hello everyone. I know it's been a while since I've done a YouTube video, but yeah, today I just wanted to recap over today's trade and yesterday's trade because it's so important and I've learned so many lessons that I just want to go over both of those trades and how they form this market maker buy model and how I won this trade today and how I could have avoided yesterday's loss and how I could have even won yesterday's trade. So yesterday, just to give a bit of context, yesterday when I lost this trade, I thought to myself, I wasn't really upset. I was a bit annoyed, but I wasn't too angry or anything because I knew that I followed my plan exactly and I followed all of my rules, everything. And only in hindsight today did I realize that actually this was a very avoidable trade. And in hindsight, with all the narratives and all the story, it does make sense to avoid this trade and to take a short instead on that day. So that's why today I will go over both of those trades and to explain price action. So instead of just giving you a strategy, instead of just saying, here's what I did, follow this, I'm going to explain how price works today in this video. Before I get into it, I want to mention that price does one of four things at any given point in time. It's always either generating liquidity, hunting liquidity, rebalancing to equilibrium, or rebalancing to inefficiencies right here. So this is taken from Justin Werlin, but yeah, this is basically what price does at any point in time. So going back to yesterday, let's start on the daily time frame. We won't spend too much time on the daily, but just to give you guys a bit of context, this is what the daily is looking like. We can see NQ is currently approaching all-time highs right here, and so we can see it's pretty bullish, and so I've been pretty bullish both yesterday and today. On Monday and Tuesday, we closed pretty bullishly as well, which is why I expected price to continue going up. Going down to the 4-hour, you can see this is yesterday's trade right there. I longed there. Yesterday, we were pretty much just pushing all the way up, and I longed here at this 10 a.m. candle, and we also have this H4 fair value gap right here created yesterday. I mean, on Tuesday. Yesterday was Wednesday, so keep that in mind. Now moving down to the H1. So I'll explain why I took yesterday's trade based on the H1. So you can see right here that there was a H4 fair value gap that price didn't tap into. For me, I thought, okay, price didn't tap into the H4 fair value gap, so that means price is really, really bullish because it doesn't even want to retrace into that H4 fair value gap. And then I saw that price has this H1 fair value gap right here. So my pre-market plan was if price was here right at 8 a.m. So if price at 9 a.m. open, like 9:30, it wants to go down and retrace into this H1 fair value gap, and which coincides with this H1 inverse fair value gap as well. So it's a BPR. So if it goes into that and respects it, then I will take a long, right? That's pretty much my plan. There's a draw on liquidity, which is this 8:30 candle right here. So there's 8:30 news. So this is data highs. So if there's data highs left untapped, there's an inefficiency that price wants to rebalance into, and it respects that inefficiency and displaces upwards, then I'll take a long. So that's my pre-market plan, which I followed exactly. You can see right here, 9 a.m. candle opens up, it goes down, respects this, taps into this H1 fair value gap and respects it. We create an SMT. So moving down to the lower time frames, I got exactly what I wanted to see. There was this is the H1 fair value gap, and we got an SMT with data lows. This is data highs right here from 8:30. So for me, it looks like a perfect long, right? We've got 3-minute fair value gap, and we've also got 3-minute change in the state right here as we close above this candle and as we close above these two candles. So it's a pretty solid change in state of delivery as well. So we've got a pretty good entry model right here with the fair value gap and change in the state. We've got a high time frame PD array that price retraced into. We got an SMT. We got a draw on liquidity. That's the 4 things that I need for my strategy. So this is exactly my strategy. And as price was pushing up, I thought this is probably going to win. So I wasn't really too concerned, but price ended up just chopping and then going down. And so I was pretty confused as to why that happened. But again, I wasn't too upset because I knew I followed exactly my plan and I did what was right to me in that moment. In hindsight though, what I should have realized was that, first of all, there was this H4 fair value gap right here. And for me, what I thought was, I also saw that on the 30-minute, price actually did inverse this 30-minute inverse this 30-minute fair value gap right here. So that was a bearish sign. But for me, my thought process was the 1 hour is higher than the 30 minutes. So 1 hour takes like priority, right? Like 1 hour price action should always be respected more than 30-minute because it's higher. So that's why I thought it can still be bullish. So I pretty much ignored that. But what I failed to realize is that on the H4, because we have this H4 fair value gap, it means that price is inefficient, basically. There's a gap there. So since higher time frames take higher priority, on the H4 there is a higher time frame fair value gap that is not being filled yet. So price would likely draw to that inefficiency more faster than to respect this H1 fair value gap, if that makes sense, because H1 is lower than H4. So remember what price does. Price rebalances to equilibrium and rebalances to inefficiencies as well. That's one of the things that price does. So on the higher time frames, you can see that it is way up in premium in this range, and we still have an inefficiency that we have to rebalance into. Now, if we take this 8 a.m. candle as well, you can see that from this range to this range, this H4 fair value gap is actually in discount of the range. So yesterday when I was taking longs off of an area which is already in premium, which means price did retrace into a H1 fair value gap, but the H1 fair value gap was in premium, which was in premium of the higher time frame as well, which means that actually price would more likely draw. You can see, right, if we just cover up this whole 9 a.m. onwards, you can see that price was in premium, so it's more likely to draw back into equilibrium and to draw back into H4 fair value gap as well. So this is my full strategy right here. The first thing that I look for is always draw on liquidity, higher time frame PD array, then liquidity sweep or SMT, then entry. You can see right here, the draw on liquidity, what I thought was that the draw on liquidity was data highs, but what the draw on liquidity actually is to go back inwards, because we just formed a range. You see, we just created this high right here, and we just made the H4 fair value gap a PD array that is in discount. When there is a H4 fair value gap, price is already inevitably going to draw back into it. What makes this fair value gap even more stronger is the fact that it's in discount, which means that out of the 4 reasons why price moves, rebalance equilibrium and rebalance inefficiencies would be fulfilled if price goes back into this H4 fair value gap, because it would want to refill this. So I hope this is making sense. I know I'm kind of like repeating myself a lot, but what I'm trying to say is that you have to look on the narrative, because what price did was it already expanded. Now it wants to do something else. It wants to go back into the equilibrium before it goes back up to take out this external liquidity, right? This high now becomes external liquidity. This high becomes something that price will take back in the future. We need to generate more liquidity for price to then go back up to take this liquidity, if that makes sense. So with this move down, we're doing 3 things actually. We're generating liquidity, we're rebalancing to equilibrium, and we're rebalancing to an inefficiency. So that is why I should have taken more consideration of this, just because of the fact that there was a H4 fair value gap that is in discount. And there was another 2 things that I wanted to mention, which is London lows and Asian session lows. Session lows are always one of the key levels that you want to look out for. For me personally, yesterday I did saw that London lows right here and Asian session lows are untapped, so I was a bit cautious. But because we had this change in the state of delivery, it does look like price is bullish. So in terms of the textbook entry, in terms of the textbook model, it does seem right just because of all these like factors. But you have to keep in mind higher time frame wise. If this whole bit didn't exist, if this whole bit was in discount and price actually retraced into these fair value gaps that are in discount, then it would have made sense. But because there's this whole gap right here, which is discount, there's this whole area right here that is still unfilled, which is why price needs to go back and fill it. So that is why I should have taken into account more the fact that London session lows and Asian session lows were not fulfilled. Were not swept yet. And the trade today was pretty much just a textbook market maker buy model. You can see after price has already gone down, respected the H4 fair value gap, and generated liquidity, it becomes a lot more easier to spot the market maker buy model. So we can see right here that we have again H1 inverse fair value gap, H1 fair value gap, price tapped into it in this 8 a.m. candle. We also have this order block right here that price also tapped into it in the 8 a.m. candle. So after price tapped into that, we also had a liquidity sweep right here of Asian session lows, and we also have SMT with Asian session lows. So I was pretty bullish going into the day. I saw that we still have this high that is untapped. We have this H4 fair value gap. So if you go down to the 15-minute, that is our market maker buy model right here. Sell side of the curve, buy side of the curve, rebalancing into this area. That is like a textbook market maker buy model right there. This is the range. We have equilibrium of the range somewhere around here. So price goes down into equilibrium and then start displacing upwards. This is the 8:30 news candle, so you wait until after news. Then I can see that on the H1 and 30-minute, there's this huge wick right here, so there's no point looking for any more PDRAs because it's already filled this H1 fair value gap. So then the next thing that I look for is just some sort of retracement. So I take out my equilibrium tool right here. It should be here. So basically we've got this equilibrium of this range. Price taps equilibrium pretty much perfectly, respects it, and then starts moving upwards. We've got this 5-minute inverse fair value gap right here that price went into. So after that, I usually like to see a bit more confirmation. I don't really like entering at the bottom. So I wait for something else, and usually my entry is always on the 3-minute. So we got this 3-minute inverse fair value gap right here. So as soon as this candle closed, I started looking for entries. So I entered on this candle right here, stops below this low, targeting that high. And this is how I got a 2-hour trade today. So that is pretty much it for this trade. If you think about it, what price would have done if it goes straight to the high, if my trade worked out, would be like this. This is what price would have looked like. This would have meant that price did not rebalance into equilibrium. Can you guys see that? For price to do these things, it needs to first go back into equilibrium, then start to go back up, right? Then displace, and then continue upwards. That is what price looks like. Price does not go up in a straight line like this, like what I was doing. That is not what price looks like in general. Another thing that I could have done yesterday was based on that 30-minute, if I had kept in mind the drawn liquidity is this H4 fair value gap, is this London session lows, Asian session lows, what I really should have done is we see that we have this 30-minute fair value gap right here, which got inversed with this candle. So pretty much at 10 a.m. onwards, we can start looking for an entry model since it retraced into that 30-minute fair value gap, inverse fair value gap. So we've got drawn liquidity being H4 fair value gap / Asian session lows. You can see right here, Asian session lows, H4 fair value gap. And we've got higher time frame PD array being 30-minute inverse fair value gap. In this case, I don't think we really have liquidity sweep, but we probably have an SMT somewhere, but I just can't bother to look at it right now. But you can see right here, we've got this change in the state. Stops above the high, targeting the low. And that would have been catching both sides of the market maker buy model if you anticipated it to be a market maker buy model. Because overall, yes, I was bullish, but again, I should have realized that price does not move in a straight line, and price needs to retrace, price needs to go back into equilibrium, price needs to go back into the higher time frame inefficiency before it goes back up. So keep those things in mind. So yeah, I hope you guys enjoyed this video. I hope you guys learned something out of it, and I'll see you guys in the next one. Bye bye.